Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of July the 1st, 2024. Now, to get started this week, we'll begin where we usually do with that very important US dollar index. Now, the needle has not moved much on the Fed fund futures bets. We're still looking out towards September, November, December for those, but that could drastically change this coming Friday with the payroll number. I don't think the Fed minutes will really affect much, but the payroll number on Friday is very important because we've seen a lot of weaker numbers. And if the Fed sees that, that could change the bets for an earlier cut in September or multiple cuts going forward. So our key levels in our VP software, our T-cross long coming in at 105.45. The Basically, we're running almost flat. The US dollar, again, is normally strong at the very end of the month into the first week of the new month, up to and including the non-farm payroll number, and then usually sells off the Tuesday afterwards. So our key support, 105.45. If we click on our F8 on our Vantage Point software, we can see very clearly that the market is hugging that very important long predicted also. Every single day this past week, you can see that the market has come down, hit that level, and then moved higher with the neural index and the neural index strength. So once again, that level is now 105.81. So support and again, for the dollar to continue to advance, you have to have hotter inflation data. This is not a technical picture, it's a fundamental one. So once again, we'll monitor the data that comes out this week with the, I believe we have some other inflation data, but those are the key levels to watch. And right now, we're basically just running sideways with a slight upward bias. Now, again, our most recent highs around 106.32. Regardless of the data, I anticipate these levels to hold, and that would be a very good selling opportunity up there. Now, gold contracts, once again, gold basically dead flat. We had a little bit of a push lower, but immediately recovered on last week's softer inflation data. Again, a fundamental trade here, guys. It's not all about technical levels. It's also about fundamentals that drive the market, like the Fed or the inflation data. So right now, gold remains firm. A test down to the 2233 area pre non-farm payroll number can't be ruled out. But once again, when we combine the levels, and again, this is a weekly outlook, guys, not a daily. So I tend to shy away from the shorter term indicators, but I do have them on screen with the neural index, the MA diff cross, and our predicted RSI. But for now, 2233 still cannot be ruled out. If we click on our F8 in the software, we can see that we've overtaken 2319, but we must stay above this level, guys, if gold is going to advance higher. The indicators still slightly negative on the predicted differences. The predicted RSI is saying we have little to no upward momentum, but again, that can change very quickly based around that inflation data next week. So we'll keep an eye on it. Gold's still a little bit soft at the current time. Now, when we look at the stocks going into next week, the S&P 500, relentless buying on this. Now, for our key levels for next week, I do anticipate stocks will pull back next week. They usually do leading up to that payroll number. So our key support level, 54.20. Indicators are actually pointing down. That is consistent with this time of the month, guys. That's the key point. That dollar cycle or dollar buying indirectly usually softens the stocks at the end of the month into the first few days of the new month. So right now, that T-cross long, we want to make sure we're also looking at that. And as you can see, we're giving that up a little bit, but a very effective trading methodology is also using the long-term crossover without the black line, just the blue line. That's all we need to see. And we can assess that the market is in daily contact with this particular level. So for Monday, our predicted low for the day is 54.48 and our long predicted 54.66. So for day trading, that's what we would look at. But we do have a gap down to 54.20 on the S&P. So again, unless we break down and stay below 54.20, buying on a dip is still the preferred strategy. Now, with Bitcoin for next week, Bitcoin under pressure again, but once again, we've got very strong support down here at 57,000. The next big move on Bitcoin, usually the end of September and October, a very good month for buying Bitcoin. So we are officially going into summer trading. I don't expect a lot of fireworks from Bitcoin next week. But again, buying on the dip, once again, a preferred strategy given the powerful trend of this particular being up 155% approximately last year and well up this year too. Our yearly opening price there, 42,501. So unless we get down below there, any move towards this area would be, again, a buying opportunity. The indicators are mixed, but we do have signs of life here. But I anticipate Bitcoin to be a little bit soft going forward because of that dollar buying that we're likely going to see next week. Now, when we do a comparative to the European equity markets with the DAX, you can see that the DAX is starting to rebound off that current quarterly opening. Now, we're going to have a new quarterly opening price for next week's outlook. That's very, very important. Each time we start a new quarter, a trend usually develops here. And I would argue in this particular scenario, that would likely be an upward trend. We can see the predicted differences are moving above the zero. We've got momentum, upward momentum, building on the predicted RSI. We just need to get above that T cross long at 18,287. Now, with the French elections, there's going to be volatility in the euro and in the DAX, but like any other fundamental event, it will pass. Now, when we click on our F8 here, you can see that we've crossed over our long predicted. That level, 18,197, we use that pretty much that exact same level, 18,216, as your buying opportunity. So for Monday's trading, the predicted low coming in at 18,194, and that matches our predicted low. So these are two levels, 18,216 on the long predicted, and the daily coming in at 18,194. So the two levels are side by side, and that's what we look for, guys, in a day trade or even in a trend, potentially a trend reversal. But make no mistake, the DAX is very firm on the year while we're above 16,828. Now, again, looking at that comparative in the VIX, we always want to make sure we're keeping an eye on this because it could be a leading indicator, often is for the dollar, stocks, even commodities, but mainly equities. So right now we've got some verified support, the verified support low approximately going back to May the 21st. Then we have another one on May the 28th, and additional support coming in on June the 12th. So that's all coming in down and around the low of 13,000, approximately 1385 on that share price. So again, you can see some buying coming in here. And the indicators are starting to rebound, but it's only a corrective move, guys, unless we get above our T cross long at 1437, and then our yearly opening price, very, very important, 1501. We would need to clear that to see the equities come under pressure. Now, again, the indicators are slightly mixed, but still mainly pointing towards, once again, weakness in the VIX. Now, when we get into some of our main Forex pairs for next week, starting with our main one, Euro US, all eyes are going to be on that with the French election, the dollar index, the payroll number, and I believe we also have a Fed speak next week too. So quite the combination of inflation numbers, payroll numbers, Fed speak. It's going to be choppy. So right now, the euro, and I will concede this point clearly, that the euro is in a downtrend in 2024. That is a fact. There's our opening price, 110.38. But I also think that the dollar gains will be limited, very limited into year end. The dollar usually rallies in part of August and September, and then that's the end of it for the year. So probably a little bit more downside on the euro here. Our T-cross long is 107.38. We're short while below that. If we click on our F8 in our software, then this is where it gets a little sticky. That long predicted is 107.06, and we have a number of 3 verified zones almost in the same area here that are building up, and that's right around 106.60. So, in my respectful opinion only, there is good two-way action on this. Buying lower into that mid 106 area and then selling above 107 appears to be the main play. But I do think we are going to see a bigger move coming this week in the euro. But again, that's a fundamental event with the payroll, the French elections, and is any of the inflation data going to move the needle on those Fed fund futures? That's what we need to see. So again, right now, if we can get above 107.06 and stay above it, then and the indicators in VP are starting to rise, then there could be some longs on the euro. But I believe it will be we're a week or 10 days away from that actually happening, or not until we at least get that payroll number on Friday. Now, US Swiss franc trying to make a move again. It's crossed over our T cross long last week, but now once again we're going to get all new updates, a new monthly opening price, a new quarterly opening price. So it's kind of an important week, but it's showing strength in the U.S. dollar against the Swiss franc. Another caught the markets. Swiss National Bank caught the markets off guard again by cutting. But there remains the question: is why is the Fed not cutting? This is the even once, like the ECB, and now the ECB is refusing to cut again until they see what the Fed's going to do. So this is all about central banks here, guys. But ultimately, they're all going to be cutting. Nobody's hiking. And that's the way we've got to look at it. So it's the dollar's running fairly firm, but it is on borrowed time here, especially in an election year. So right now, that monthly opening price that's coming in at or about 90.34. That's your resistance for next week, and your support is our T cross long at 89.57. And again, if we click on our F8 in our VP, you can see using that long predicted, the long-term crossover with just the blue line, we're getting some good movement, good daily buying off that, guys, right? And for Monday's trading, we've got our predicted low at 89.68 that almost matches that long predicted at 89.60. So it gives us a very clear picture as to where that support is, but also where the resistance is. Now, the pound dollar, once again, recovering somewhat, but we've slipped below 127.32. So from a technical picture or a price action based, it's still bearish. So, but we don't have any buyers, but we don't really have any sellers either. So the most recent verified support low, 126.22, that's the key level to watch for next week. Can we break below it? But again, remember there's a Canadian holiday on Monday and I believe a US holiday on Thursday, on July the 4th. So you've got with a considerable amount of economic data coming out. So it's going to be very choppy. So the pound, I believe, will come under a little bit more pressure, but the indicators, if looking at the neural index strength, now this is interesting. The neural index is red, but the neural index strength is pointing up. That's what you want to look for from a type of divergence, because the neural index strength gives us a window in to see what the neural index is looking at inside of it, and it's actually pointing up. So maybe a rebound on Friday, and then, or excuse me, on Monday, and we'll see where we end up. Now our F8, that's pushing lower also. That level's coming in at 126.57. So we know where our resistance is and we know where our support. But as you can see, if we lose the 126 level, that potentially could be a big problem. That could potentially open up the door to the 124, 125 area. And if you get a hotter non-farm payroll number on Friday, that area would easily be tested. Now, the dollar yen, everything is on intervention from the Bank of Japan. But in my respectful opinion only, they tried the intervention and this is what they got. So this is their mess, guys. And the yen is really taking a hit. So how much further can they push this before the Bank of Japan steps in? But even if they do at this point, I don't think now they're fighting a very powerful carry trade with the Fed refusing to cut. And again, the interest rate differential between the Bank of Japan and the Fed is substantial now at over five, I think around 5% difference. So they're not leaving this long trade. So the Bank of Japan has their work cut out, but this pair is going to be very, very volatile. I could see, regardless of the data, the market coming back down to our T cross long 158.74. If again we look at our F8 here, you can see that the buyers are consistently picking this up on a daily basis. But what you really want to do here, guys, is when this works the best, is when you get either the long predicted of the T cross long and the daily predicted low, where they're very close to each other, so that there's no gap to fill here. So there's a bit of a gap to fill on the T cross long, but not a lot. Now, the Aussie benefiting, they're starting to see a little bit of a hotter inflation data too. But again, the 2% target is a made up number, guys. That's all I can tell you. Where the history of the 2% inflation target came from, not from any economic paper that I'm aware of. It came from the finance minister in New Zealand. And he just blurted it out one day and said, okay, well, we're running really hot inflation at 16%. I think it was in 1987 or 1890. You can Google it, 86, 87. And he said, I think we're going to go with a 2% inflation target. But it wasn't based on anything. So next thing you know, the Bank of England and the Bank of Canada pick it up and they said, okay, we're going to go with 2% too. Then the FOMC hires a Canadian, Ben Bernanke, and he turns around and says, I think we're going to go with 2% also. So again, we can debate this up and down, but the reality is they're likely all going to have to cut here. And when the US does, the dollar is going to take a hit. So they're refusing to exit stocks. They're refusing to exit gold longs, the metal long trades. That all helps the Aussie, the equities, the commodities. So right now, that T cross long, 66.46, you can see looking at this chart that there is significant resistance up here. The yearly opening price, 68.12. We're still negative on the year. But when the dollar turns, this pair will be a very good buying opportunity, as will the Kiwi. And as you can see, the difference between, this is a question actually I got from last week. And if you guys want to email me questions, etradefx@gmail.com, I'm happy to answer those, any of your questions. But the difference in what's happening here, yes, that inflation data is why these two pairs are not running both above the VPT cross long. But your culprit, guys, is this one, Aussie New Zealand. And for the Forex traders watching this, this pair has become very attractive to me. Instead of trying to trade Aussie US or New Zealand US all the time, I tend to now go after this one. And as soon as we crossed over our T cross long, you can see that we started to advance. So in theory, you can buy Aussie US and you can buy Aussie New Zealand as a dual trade because the Kiwi's the one taking the hit. But the indicators here, and to sweeten the pot a little bit here, you can see the yearly opening price, how we basically rebounded right off that area. Then we crossed over our T cross long, and it led to a pretty substantial rally without that worrying about that how the US dollar is affecting the New Zealand or the Aussie. Like the Aussie New Zealand pair, guys, it's made up of Aussie US and New Zealand US. It's a synthetic cross pair, and so we can take advantage of these cross pairs if we understand how they actually work and how the dollar comes into play. So we have a very, very full docket next week. We have, again, a holiday in Canada, a holiday in the US, I believe, on Thursday. So you're going to see some real choppiness, but with that will come opportunity. So with that said, this is the Vantage Point AI Market Outlook for the week of July the 1st, 2020.